In this video, I'm going to discuss the various options you may be considering when you want to start selling in the UK and the rest of Europe. And more specifically, what we're going to talk about are the different sort of company setup options you've got and whether or not you want to or have to register for VAT when trading in the UK. Now, before we go any further, I will say, I'm not a financial advisor. Don't take what I say as gospel. You really do need to do your own due diligence and get your own financial advice from a CPA in the US or, a proper accountant in the UK. Now, let's carry on. So when you're trading in the UK, you can trade through a number of different entities. It could be your own company in some other countries. So if you're based in the US, you might have your own LLC, or if you're based in Australia, India, China, you might have your own company already set up there. And you can trade in the UK using that entity. But another option you've got is actually setting up a UK company. And there are some little benefits in doing that. You can save some money on VAT. So we're going to have a look at those two different options and dig in a little bit deeper about why setting up a UK company might be beneficial when you first start trading in the UK. Now, before we start digging in deep, I just want to cover some basic terminology that I'm going to talk about. Many people will already have heard of VAT and HMRC, but I want to just go through it so that we're all on the sort of same level. We know what VAT is, and it will help us understand some of the examples a little later on of how we can possibly save money with VAT. So, VAT, what is it? Well, it's just a tax, okay? They call it value-added tax, and you can see with the slides here, it's a tax levied on the sale of goods or services by a UK business. So as a UK business owner myself, I've got to charge VAT to all my customers on everything I offer. Now, when I charge VAT, I also have to collect it myself, or the company does, and then hand it over to the HMRC. Now, the HMRC is just the UK government. It's our taxman. So when you see that term HMRC, it does stand for Her Majesty's Revenue and Customs. It's just the body in the UK that's going to collect the tax. And as a UK company, when we collect tax from our customer, we have to hand it over to the HMRC. And for most small businesses, we do that on a quarterly basis. Now you can see down here, I've got an example of the types of VAT calculations that we have to do. So let's have a look at this. Let's say we're importing goods, okay? And the cost of the goods that we want to import is £1,000. Well, if it's a standard product, there's going to be a VAT rate of 20% that needs to be applied. So when you import your goods, an additional £200 is going to be calculated and put on top. So your landed cost of goods in the UK will end up being £1,200. And this £200 gets collected at the time of import and is handed over to HMRC. Now, once your goods are in the UK, you can then sell them to your customers. So then let's say the total of your sales to customers equals £6,000. So you might think, okay, £1,000, 6,000, I made £5,000. Well, you pay £200 VAT, but also you've got to charge VAT to your customer. Okay, so your £6,000 price tag, what the customer has paid, is going to be made up of a 20% VAT and then the value of the goods. So in this case, if your price tag is £6,000, your goods are worth £5,000. That's what the customer's paying. And then the customer's going to pay an additional £1,000 in VAT. And because you as a company have to collect VAT from your customers and hand to HMRC, normally you would hand that £1,000 over to them. But remember, you've already paid £200 when you imported these goods. And as I stated up here again, a company pays VAT to HMRC by calculating the amount of VAT charged to customers minus any VAT that they have paid on their own purchases. So you've already paid this £200 VAT on your own purchases, your imports. The customers paid £1,000, so you have to pay HMRC the balance. So it'll be 1,000 minus 200 you've already paid. So you end up giving £800 to the HMRC. So from the taxman's perspective, yep, they have received £1,000 in total, and that was made up by your initial £200 VAT payment, and then the customer's balance £800. So now we have an understanding of what VAT is. Let's have a look at the different entities we can use to actually trade in the UK. So first of all, let's have a look at trading using your own foreign entity, your own company. So whether that's a US company, China, India, we're going to use that company to start making sales to customers in the UK. And when we do this, there are a few things that you've got to bear in mind. As a foreign company, if you store all your stock outside the UK, then you have the option of not having to register for VAT. And this means you can start trading straight away. Yes, you do have to ship all the items yourself to your customers, but you can start trading immediately. There's no restrictions. But from the customer's point of view, this might not be an ideal situation, because when they receive the goods, if they're over certain values, I think it's £15 for VAT and £135 for import duty. Well, if the value of the goods are above those limits, then there's a really good chance that when they turn up at your customer's door, they're going to be presented with an additional bill. They'll have to pay VAT and import duty on the goods that they've just received. So what else can we do? Well, you do have the option of storing your stock in the UK. But here's that catch-22. If you do that, there's a rule that you have to register for VAT. The law of the land says in the UK, if you just store your goods in the UK and distribute them to customers through a fulfillment centre like Amazon's fulfillment centres or any other type of fulfillment centre warehouse, you have to register and charge your customers VAT. And when you do that, you have to follow that 3-step process that we went through on the last slide, but I've just highlighted it here. So let's just go through it. You bring goods into the UK, they're your purchases. You store them at the fulfillment centres. But when you do that, when they come in, when they're imported, you have to pay VAT to the HMRC at that point. Then when your goods are sold to your customers, you have to charge and collect VAT from them. And once you have their VAT money, you then have to pay the balance to HMRC. And as I mentioned before, that's the difference between the sales VAT amount and your imports VAT. This is just the example from the last slide that we've been over. So the rules are pretty straightforward. If you store your goods outside of the UK and ship direct to your customers, there's no need to register for VAT if you don't want to. But if you do store your goods in the UK, you have to register immediately, start charging your customers VAT, collecting that and handing it over to the HMRC. Now let's have a look at the second option for trading, and that will be trading using a UK registered company. So even though you might have a foreign company set up, you might want to consider setting up an additional UK registered company. And the reason for doing this is because you can save a good amount of money when you first start trading in the UK by not having to register for VAT. So let's go through this slide and hopefully it'll explain things for you. So as a UK registered company, you have the option of storing your stock inside or outside the UK. Most of the time you're probably going to store it inside. But here's where the difference comes in now. When you're a foreign entity trading in the UK, with stock in the UK, you have to register for VAT immediately. Well, if you're a UK company, you don't. You can trade up to £83,000 in sales. That's the current limit, does change each year. But you can make that amount of sales without having to charge your customers VAT. And what this really translates to is you can be saving up to £13,833 per year. Now you still do have to pay VAT on the things that you import into the country and any purchases you make in the UK, but the big benefit is you don't have to pay VAT to the HMRC on your sales. So if I jump back to the previous slide, we can see, the old scenario where we import the goods, £1,000, we pay £200 VAT, we make the sales to the customer, and we collect £1,000 in VAT and hand that over to HMRC. Well, it's this part that doesn't have to happen. You can still charge your customer £6,000, but instead of handing over the balance, the £800, you get to keep this. And if my maths are right, when you're trading £83,000, you get right up to that limit. That does give you a big saving, that $13,833 right in your back pocket. So that's the big major benefit of registering a UK company and trading that way. Now, what happens when you trade above £83,000? Well, unfortunately, you have to register for VAT at that point. And what that will mean is you then have to start charging your customers VAT on every single sale you make. Now, before we move on to the next slide, let's just cover this bit. It's a special note saying, and it's really, it might be 0.01% of companies would fall into this bracket, but if you purchase or import goods with a value above 69165, then you may be better off registering for VAT straight away, because this value, 69165, if you work out 20% VAT on that, it's going to come to this 13,833 or maybe 34. So this is really the limit on your company purchases that would offset this great big saving. So if you're importing goods, maybe 75, 85, 95,000 pounds, then because you're going to be paying VAT on those, when you work out the 20%, let's say it's 100, let's say, now make the maths easy, £100,000. If you're going to pay 20% VAT, that's £20,000 in VAT that you've got to pay. Well, that's way above the saving of not registering for VAT. So if you register for VAT straight away and you're paying £20,000 on your purchases, this bullet point here comes into effect where you can claim that amount back from HMRC and it will offset this £13,833 saving. Now let's move on. This is the last slide before we have a look at some examples. And I just want to mention that VAT is not just one size fits all. Many foreign companies, when they're first looking, don't really understand that there's actually a number of different VAT schemes you can join. Now the standard one, I've called it standard here, you just charge the standard VAT rates on all your sales. And then just like I've explained previously, you can then claim back all the VAT that you pay on your imports and company expenses. But there's also these things called flat rate schemes. And if you haven't heard of flat rate schemes, you definitely want your accountants to consider registering you for a flat rate scheme when you do get to that £83,000 in sales threshold. Because a flat rate scheme can save you some money. Now, if you're an Amazon Marketplace seller, the flat rate scheme you would go on to, I think, is called Other Retail. Okay, and the flat rate VAT percentage that applies to that scheme is 7.5%. And the way that this can help you is you'll still charge the standard VAT rates on all your sales, but you pay a reduced flat rate to the HMRC instead of claiming back VAT on your imports and purchases. So let's have a look at this example down here. If you sell an item for £120, your flat rate payment will be 7.5% of that sale price. Now that sale price, don't forget, includes VAT. But with you being on the flat rate scheme, you'll only pay 7.5%, which will turn into £8.40 to HMRC instead of £20. Now you can't stay on a flat rate scheme all the time. There are still trading limits that apply. And with a flat rate scheme like this, and I think the current setup is you can apply to go into a flat rate scheme as long as you haven't traded above 150,000 in a financial year. And this 150,000 is strictly on when you first apply. Okay, but once you're accepted, you can then trade all the way up to £230,000 in a financial year and still pay this flat rate scheme. But this is where you'll need to speak to an accountant, and they will advise you if you can stay on that flat rate scheme or not. Because I think it's supposed to be, if you think you're going to trade above, I can't remember exactly what it is, it's about 192,000, then you're supposed to register for the full standard scheme. But if in a financial year you do up to 230,000, but then you say that's just a one-off, I'm normally going to be making sales of, let's say, 180,000, you might be able to stay in it. That's where your accountant can work out the best deal for you with the HMRC. So that's it for the slides. What we'll do now is take a look at some examples and just have a look at how much money you can save by using a UK company versus a foreign entity and not having to register for VAT straight away, and by taking advantage of the flat rate schemes. So this is a spreadsheet I put together to try and illustrate some of the savings you can make by trading through a UK company and taking advantage of this £83,000 threshold that is currently in place. So let's go through it, starting at the top left. So here we've got like 3 examples. The first one is you're a UK company and you are not VAT registered. Okay, so this means, let's have a look at this section. You can make sales up to £83,000 and the VAT paid on those sales is 0. Now, it's not all unicorns and rainbows, you still have to pay some VAT. So if you're buying goods in the UK or you're importing goods, let's say here you import £15,000 of goods, you're going to pay £3,000 in VAT when you import them. And if we look over on the right, we can see a summary on this side, and we're saying on sales up to £83,000 per year, you're going to pay £3,000 in VAT, and that's your import VAT. And we can see these examples. If you're importing £75,000, you'll end up paying £15,000 in VAT. Pretty straightforward. Now, I won't look at these boxes just yet. We'll go on to the next one, and then we can refer back to the savings. Now, if you're a company and you are registered for VAT, and we'll look at this same £15,000 import value, but just the same, you're going to pay £3,000 on import VAT when it comes into the country. But then when you're making sales, because you're VAT registered, you've got to start handing over the VAT you collect from your customers to the HMRC. So on £50,000 of sales, you're going to be collecting from the customer £8,333 in VAT. And as the sale values increase, you can see how much you're going to be collecting in VAT. So up to £83,000 in VAT, this is that magical £13,833. That's how much VAT you're collecting. And if we look at the summary box on the right, that's saying in total, throughout the year, on £83,000 in sales, you're going to have paid £13,833 to HMRC. Now let's compare that against not having to register. So if you make £83,000 in sales and you're not VAT registered, all you're paying is £3,000 versus having to register for VAT, you end up paying £13,833. So here you can see the saving. So the best saving in this example on import values of 15,000 is £10,833. That's quite a saving just by taking advantage of this £83,000 threshold. Now, the more purchases you make in the UK and sort of imports that you bring in, the actual savings do start to drop down. So the more you spend within your company in a tax year, the savings do reduce. And we can see here that once we go above that, I forget the number, like £69,000 and some change, then you would actually be better off registering for VAT from the very start. Because once the VAT amount that you're paying goes above this £13,833 level, then it means you're going to be paying more VAT. So you want to be registered so that you can claim that back from the HMRC. So that's where the saving goes into the negative. But this is really, it doesn't happen very often. Nearly all companies are going to want to take advantage of this £83,000 threshold and not register for VAT straight away. Now let's have a look at, we'll go down instead of moving to the right. We'll have a look at this. This is the flat rate scheme example. So any company that's VAT registered that goes onto the flat rate scheme will pay different amounts of VAT. So here we can see this £15,000 import value again. You'll pay £3,000 import VAT, but because you're going to be on this 7.5% flat rate, if all you sell is £50,000 in a tax year, all you're going to be paying is £6,750 in VAT versus the £8,333 if you're on the standard scheme. If we go all the way up to the £83,000 sales threshold and have a look at those figures, well £15,000 import value gives you that £3,000 import VAT you got to pay. But then here we can see quite a difference compared to the standard scheme. Here we're going to be collecting £6,225 VAT from the customer versus £13,833 on the standard scheme. So that's quite a saving. If we look at the total amounts based on £83,000 in sales, for £15,000 import, you end up paying a total of £9,225 compared to not being registered for VAT. You can see here the saving would be £6,225. And that's worked out by taking this £3,000 VAT away from this 9,225. And you can see here, compared to the flat rate scheme, the savings are constant. It doesn't matter about the import value. So have a look at the different figures here and sort of try and estimate how much saving you can make in your business depending on what sort of figures you think you might be doing in the UK when you start selling. Now I've got a few other examples. These columns are just saying, all right, let's have a look at the figures based on £150,000 in sales, £230,000, and then anything above. We're saying up to £300,000 in sales here. So on £150,000 in sales, well, you're above that £83,000 threshold, right? So you can't make any saving here because you've got to register for VAT. So let's come down here. If you're on the standard scheme, you'll end up paying £25,000 in VAT on £150,000 in sales. Compared to the flat rate scheme, you would pay $14,250 versus 25, giving you a saving of £10,750. So that's pretty good, isn't it? I mean, it's really worth considering this flat rate scheme. And as you can see on the different examples, the savings do diminish the higher your import values are, but you do have to import a lot of goods and make a lot of purchases in the UK before you would want to switch over to the full rate scheme. Now this £230,000 example, I said you can trade up to £230,000 in a tax year and still stay on the scheme, but it has to be like a one-off. But let's have a look at those figures. So based on £230,000 in sales, in a given tax year with the current rates, you would be paying £38,333 in VAT. Compare that against a flat rate scheme, 15,000 imports, 20,250. So that's even a greater saving. £18,000 you're saving by being on the flat rate scheme versus the standard. And once again, as the import values increase, the savings diminish. And the last example really just shows you once you're above £230,000, well, the game's up. You have to come off this flat rate scheme and go on to the standard scheme and pay the full whack. That's what most of us end up doing. And that's what I did some time ago. It's a real shame. But that's just the way it is. So you can see with this example, really to try and summarize it, I would advise anyone to really consider setting up a UK company to start trading in the UK, because you can take advantage of all the VAT savings that can be made, whether that's trading up to the £83,000 level, or making use of the flat rate scheme once you're above the 83k, because you can make some massive savings. That just about finishes this. If you've got any questions, please let us know. I hope it's been of some use, and if you need help with setting up a UK company, and the real tricky part is actually setting up a UK bank account for your company, then get in touch, because we have some contacts that we trust and we know do a great job for the clients that we have on our fulfillment centre in getting them ready to trade in the UK. Take care.